Welcome back to the channel. Let's unpack. A lot to talk about this week. Going to get into some of the most popular rates available right now in those 3 and 5 year terms, especially the fixed and variable. Have a conversation, especially with those Canadians, lots of Canadians actually, looking at their options and solutions, whether they're looking to buy, restructure, refinance, or just renew their mortgage. A lot of mortgages set to renew. Want to talk about rates and about the Bank of Canada's potential next move coming up on July 30th. A lot of questions, a lot of conversations on whether or not the Bank of Canada made a mistake by not cutting earlier this month, or if they're going to actually move the needle in July. And I think there's a lot of data that still needs to come out in order to get some clarity on that, but we'll share our thoughts and opinions this week. Once again, thanks for stopping by. If you have not yet subscribed to the channel, please consider subscribing. Hit that subscribe button, hit that notification bell. More importantly, like and share the video, but leave your thoughts, questions, and concerns in the comment section below. Let's get into it. So ultimately, right now with the Bank of Canada, we've talked about where the Bank of Canada stands. They held that policy rate not too long ago. I believe that they did make a critical error. We'll see how bad that error plays out over the next little while and if they can recalibrate at the next meeting at the end of July. If they don't end up doing it at that point, then we'll have to wait till September. Now, obviously, the Bank of Canada, yes, can make a move in between that if the emergency measures, if the Bank of Canada sees that there's big problems brewing ahead, they can cut at any time. I highly doubt that that's going to happen. The economy, according to the Bank of Canada, still seems to be quite resilient here. We see economic growth, according to the Bank of Canada, resilient for Q1. But as we discussed in those previous episodes, a lot of that was front run, a lot of it was front loaded. That's not going to be the same case in the second part. And ultimately, right now, we have to pay close attention to a couple of other key drivers. Those drivers, what are they? Unemployment, the CPI numbers. What are those numbers going to tell us? So next week on June 24th, we have CPI, the Consumer Pricing Index. And if we see that those numbers continue to either go up, if we see those core media numbers continue to tick up, well, that could be a problem for the Bank of Canada, as well as if headline inflation continues to maybe stay relatively flat or increase. We have a lot of these tariff fears, these uncertainties, especially around what is being impacted, playing into the economy. We have a lot of conversations right now around all of this, the uncertainty. So this is literally an interesting time right now. And if we look or lean on a little bit of those deliberation comments from the Bank of Canada's last meeting, what's happening behind closed doors, they talk about it. Well, the Bank of Canada is leaning on, hey, the fact that we could have held policy rate because of the tariff uncertainty. They saw the Canadian economy being resilient, so there was really no need. But once again, were they factoring in that a lot of these transactions, a lot of these exports from Canada that caused the GDP number in Canada to jump up unexpected amount for the first quarter, was that all because of tariff scares, right? It's not because the Canadian economy necessarily is doing well. It's because a lot of American buyers of Canadian products were saying, hey, you better get that stuff over to me, filling these PO orders really, really quickly because we don't want to pay an additional tariff on those potential goods. So all of that, very important. If we see unemployment tick up, last reading was at 7%, ultimately much higher in provinces like Ontario. And that is going to be a big potential warning sign for the Bank of Canada if we see that. And although some will argue and say, yes, that unemployment rate is ticking up, but we did have a huge amount of immigration and it's only impacting the young. Well, at the end of the day, the unemployment rate means there's higher pressures, more demand on the Canadian government to subsidize, obviously, unemployment. All these things leads to a higher deficit. You see the snowball continues to run. So we'll see what happens. Obviously, a little bit too soon to tell. Let me know your predictions in the comment section below. What do you think the Bank of Canada is going to do? But let's get into some of these really popular rates. I know that's what a lot of people are tuning in for. So right now, we're going to talk about the insured mortgages. As you may or may not be aware, insured mortgages means you're buying with less than 20% down. If you're buying with less than 20% down, you got to pay the premiums, right? The default insurance premiums apply across all major insurers here in Canada. That's Sagan, Canada Guarantee, and the big boy, we have Canadian Mortgage and Housing Corporation, CMHC. And ultimately, as we look at these particular products, some of the 3-year fixed rate mortgage we're seeing as low are starting at 3.89 to 3.99%, depending on the lender. We've seen them go up to as around 4.04%. And ultimately, depending on where you want to go, what types of products, what kind of frills or no frills you're looking for in your mortgage, you've got to pay close attention to those penalties, as well as a lot of these clauses around portability. We also have the 5-year insured fixed rate. That is also in and around the high threes. We've seen them as low as 3.99. We've seen them as high as 4.14 to 4.24 for an insured model. Ultimately, that depends on the lenders. And more importantly, that is going to depend on the fact that we see Canadian bonds in the market right now continuing to rise. So if those bonds continue to rise, so will those fixed rate mortgages. Generally, the insured mortgages are the first to get impacted or the first to see some change, especially when it comes to the broker-friendly banks. So something to pay close attention to. Make sure you're subscribed. We will do future episodes talking about these rates. And if you're looking at a variable rate product right now, on the insured side, we're seeing anywhere from prime minus 85 to prime minus 1%. What does that mean? Well, you're looking at potentially around 3.95% to anywhere to 4.1%, depending on the product, depending on the variable. And remember, just a key point to understand on the variable, there's products that are what we call adjustable rate. Adjustable meaning they move with the Bank of Canada. They go up and down when the Bank of Canada policy rate moves. Every time Tiff Macklem comes out, makes an adjustment or doesn't make an adjustment, your payments can move lock and step with that. Obviously, the bank's prime rate will impact that. And then there's the static variable rate mortgage. That's where the payment doesn't move. So the Bank of Canada can continue to cut. Your payment continues to stay the same, and just more money gets applied to principal interest. So be very cautious. And ultimately, if you're looking at your conventional products, these are really big right now. Those are where you're not paying the default insurance premium. You can buy for over 1.5 million or refinance. Ultimately, you don't have to take a 30-year amortization. Remember, back in November, December, the banks sort of changed these rules. You're now able to buy a insured property up to 1.5 million if you qualify, and you can take a 30-year amortization if you're deemed a first-time home buyer. Talk to your mortgage professional if you have questions about that. But more importantly, conventional mortgages, we're seeing them in the low fours, starting in around the 4.04% for a 3-year, 4.14, 4.09 to 4.34% for a 5-year fixed. And for a variable 5-year, you're probably looking anywhere around 4.3 to 4.4%, some a little bit lower. Most important thing to understand is for switches and transfers, depending on what we're doing, depending how you're doing it, obviously talk to your mortgage professional, get the best option. If you're switching or transferring from a federally regulated bank to another federally regulated bank, try saying that a few times, basically what ends up happening is you don't have to undergo the stress test. But if you're going from some of these broker-friendly banks or alternative side into a major bank, or vice versa, if the situation got worse, then you have to undergo the stress test. That can complicate things for a lot of people, and especially if you're refinancing right now, something we talked about previously, sometimes those appraisal values are not coming in, or they're not coming in as expected, and we're having to play around with those mortgage amounts. Sometimes clients need a lot of that equity. They need to maybe go up to 80% loan to value. That's basically the maximum amount you can structure a mortgage to, right? The thing about $1 million house, the maximum you can go up to, providing you qualify, is $800,000. You have to keep 20% of equity in the property if you want to work within the banking space. There's obviously potentials for alternative space, but you don't want to go there. And if you don't have the equity there, that can hinder your ability to restructure and consolidate debts. A lot to unpack there, a lot to really reconsider. The best advice I can give to our clients is obviously get an opinion, get a conversation going with a mortgage professional, whether that be with your bank, a buddy, a mortgage professional, someone here at InTouch Mortgage Solutions, free plug. I mean, ultimately, the idea is to get as many options and understand what you can and cannot do with your mortgage so that you can keep thousands of dollars in your pocket. Hope you found the video helpful. If you did, feel free to share the video with a friend. Share the information. Let's get this content out to as many Canadians as possible. And once again, I thank you for stopping by, and we'll see you all next week.